Hello, and a very warm welcome to the Property and Investor Podcast. This is the podcast when I speak to some of the most interesting, inspiring, and resilient people, property investing and beyond. I, of course, am your host, Paul Lanfear. Now, as you know by now, at this stage in the podcast, I always have to allow my inner lawyer to say something, which is nothing in the podcast. It's financial advice, health advice, legal advice, investment advice. Naturally, you'll seek your own professional advice, but of course, you know that. Now, it is with real pleasure I introduce today's guest. So today's guest is bringing an absolute depth of experience for us. So it's Jason Living. And let me tell you a little bit about Jason before I say hello to him. Chartered Surveyor, been in property for 3 decades. He is the founder and managing director of Argyle Square Property Group, which own an astonishing 170 properties with an estimated value of over 15 million. And now he has a short-term rental business in Sunderland that caters for contractors and leisure visitors alike. Offices in Sunderland, properties in the northwest, northeast, and central London. Jason, a very warm welcome to the podcast.
Thank you very much, Paul. It's a pleasure to be here.
Now, you will not remember this, and my ego is sufficiently tamed that I am not going to be offended by the fact that you don't remember this. But actually, you came, because I checked this morning, you came to my first ever Property and Investor Breakfast in November 2017 at Alton Hall. And
I do absolutely remember it. Yeah.
So I'm very grateful for that for a start, because obviously the breakfasts have taken on a life of their own. I was also saying just before we got started, I think I saw you speak almost a decade ago. Now, I don't say that to make us both feel old, Jason, but I say that to emphasize how long, you've been in the business.
Mm-hmm. Yeah, no, it probably was. Maybe slightly less, just thinking about sort of events that occurred and things that I know I then spoke about, but it's certainly approaching 10 years, I'm sure.
Very good. So look, one of the things I really want to get into is the depth of experience you have got in property, because you've dealt with a very specific set of circumstances which obviously occurred a long time ago now, but I think whilst history doesn't repeat, it does echo, it does rhyme, doesn't it? And I think there's a lot we can learn from the past. I think particularly, for, and I say this with no hint of criticism, for investors who've only ever invested in effectively a rising market, a sideways or downwards market is a very different experience, and there are different consequences. So can you just talk us through your property origin story? And I noted with real genuine interest when I was doing a bit of research that you studied land management. So
absolutely,
pick it up from there. Like, you're at uni, you're studying land management. What happened?
So yeah, just to sort of make that clear, because I think it's a poorly named degree in the sense that I think people associate land management with sort of agriculture and the rural side of things, but most of the degrees that would lead you to a chartered surveying qualification are called something along those lines. So I know the Cambridge degree, for instance, is called land economy. I did the Reading degree, which is land management, and I think the only way to sort of get beyond what I think is a misnomer to say it's land management in the widest possible sense. So it's the management of land and buildings and everything that goes on with it, I guess. But fundamentally, it's if you like, it's the precursors to being a chartered surveyor. So yeah, you can do all of that sort of on the job, as it were, and it takes quite a long time. Or you can go and do a degree, which effectively gives you the bulk of the qualification, and then a bit like being a lawyer, you then do a couple of years to actually get your full qualification and have to sort of do various things and keep diaries of experience and that sort of stuff. So yeah, land management, but effectively a degree in chartered surveying, which is what I then went into. And in fact, within that degree, there were sort of three streams of specialism. One was the rural stuff, so people who want to go and be sort of agricultural land agents, that sort of stuff. What's generally termed general practice surveying, which is valuation, landlord and tenant stuff, sort of general commercial surveying. And then I specialised in planning and development. So I went from Reading to London, worked for a firm called GL Hearn as a commercial planning consultant for well, in London for about 7 or 8 years, and that was good. They were probably not as well known as a lot of the commercial firms because they weren't commercial agents, and those are the guys who have the greatest, I suppose, sort of presence. But they had two big specialisms: rating, which wasn't something I dealt with, and planning and development, and planning particularly. And they had some, really good high-profile clients. We did a lot of food retail work. Tesco were certainly my biggest client, but also worked for Sainsbury's, Safeway as they were then, Asda, most of the food retailers. And it was, I suppose, what you might now call the heyday of them getting out of centre large format stalls. So we were involved in those sites right from the beginning, through planning, often refusal of planning because local authorities didn't particularly like these big stalls on the bypass. But government policy was perhaps more in favour of them, so we'd end up going to some pretty major inquiries with in that day the top planning barristers of their time. It was that was fascinating to be exposed at that sort of level. So so it was really interesting times, and that was through to 1996, and then I got married, and for various reasons we ended up moving to Yorkshire, and the firm GL Hearn I worked for have an office in Sunderland. So I sort of engineered myself a position there, really. They didn't do a lot of planning work. So I became the sort of planning person for that office, and did that for about 4 or 5 years. But in that time, I suppose not long after I landed in Sunderland, I'd got one property in London by then. So I bought a flat with a friend. We lived in it initially, and then he moved down to Somerset. I moved out of the flat, and we rented that out, and we still have that flat today, although I've at some point in the process bought him out along the way. But we still have that property, whatever, 30 odd years later. So yeah, got up north, as it were, in Sunderland, looking through, this was, I suppose, pre Rightmove and internet days, really. So flicking through the local paper on a Friday, which was property day, and a property caught my eye, I think because it had a reduced flag across it, and it was a house divided into 4 flats, yielding about £10,500 a year, and it said, and the price was £44,000. So I naively phoned up the agent and said, I presume that's for each flat. And they said, oh no, that's for all 4 flats. So quick maths, it was yielding something north of 25%, which looked quite interesting. Even though in those days, certainly commercial rates which we paid when we bought that were probably around 12%. But even so, there was a decent margin there. So, and that took some time to get that one across the line. I think we eventually paid 42,000 for it, got a little bit of a discount off the asking price, and that was the first sort of investment we made in the northeast. And then off the back of that, bought similar properties, using sort of some friends and family equity and borrowing the balance. And then we end up with 4 of those properties. We then refinanced those. So initially we were with Nationwide, and then we refinanced those with Bank of Scotland, and they'd gone up in value. So we then had a bit of a cash pot and really just kept that rolling. And I guess by the early 2000s, so I resigned from my sort of full-time chartered surveying job in about 2000. I was fortunate, really, in the sense that they didn't have someone to immediately replace me. So I worked part-time for a period, and then I had a project on the go with Asda, and they were keen to retain me to work out that project. So I had a period of sort of full-time employment, part-time employment, and then a bit of consultancy, which probably lasted sort of 2.5, 3 years. And as I said, that was more by luck than design, but it was nice to have that bit of other income in addition to the rental income. And we grew the portfolio, buying really very similar properties in Sunderland. I think we've got 23 of them now, so large houses divided into flats, what now seems to be termed multi-unit freehold blocks, albeit the smaller end of that, so between 3 and 5 flats. I think there was an odd HMO in there at that point again, which we've still got, and just a few single lets. And then I guess I started to sort of expand my horizons, and I think and I got involved with an organisation called a Quick Sale, who were a direct to vendor ideally below market value marketing organization, in the sense they then had people like myself, who were investors who received those leads from the marketing and would then work those and pay a fee to a quick sale. And at the time when I got involved in that, I thought, we've got a fairly large rental portfolio by then, probably something over 100 units. And I thought this would be really good from a buy to sell point of view, because I'm still of the view, and I think with the interest rates as they've been, we've had a bit of a golden period. But if you are using a relatively highly leveraged strategy, it is quite challenging to make decent income from rental property, even now. And even if you have some good times, you've only got to have 2 or 3 boilers go pop, or a roof needs replacing, and all of a sudden you haven't actually got the income you thought you'd had. So my thought process at that time was, great, we can get into this quick sale stuff. I can buy stuff at a discount, and either flip it on, whether it needs work doing to it, or do the work or not. We were buying at enough of a discount, and we started doing that. But I think then, as time went on, the finance market expanded, and it was, it became ever easier to borrow money, and rates, came down a bit. I think they were down at about 4% base rate at that time. And so some of those properties that we would have bought and flipped started to stack up from a buy-to-let point of view. So we started retaining quite a lot of those properties we were buying at a discount, and then sort of grew the portfolio further through to sort of 2007, when by then we had around 200 properties, as well as having flipped a fair few along the way. So that was the sort of massive growth period. And obviously there's a number of lessons I can draw out of that, and I think probably best to sort of complete the story and then perhaps come back to some of those lessons. We got to sort of 2007, 2008, and I suppose it was about mid 2008 that things started to look a bit different, shall I say. The financial market started wobbling a bit. A lot of things going on. But I think at that stage, everyone thought, it'll be a bit of a slowdown, maybe a bit of a soft landing. But certainly through that back end of 2008 back in 2007, into early 2008, the market really came to a pretty juddering halt, really. And a big part of that was the lack of availability of mortgages, whether that be on the investment side or on the owner-occupier side, which is, and again, we'll draw the parallels, is quite different from, I think, the way the economy sits at the moment. And at that time, we had, I think, about a dozen properties on the market that were flips, and they tended to be the higher value ones that didn't stack up for buy-to-let. And sort of early 2008, and even at a discount, it was very difficult to get rid of these properties, because fundamentally nobody could get mortgages, or it was extremely difficult to get mortgages. And so we just had to hang on to those properties and let them out, even though there was a shortfall at that time. And then from sort of middle 2008 through to March 2009, that was the period when base rate fell from 5.75 down to 0.5% through that period, which then made those properties profitable. And in the middle of that, we'd also sort of started to look at commercial property, because that seemed to me to be the sort of next logical step in terms of progressing the property side of things. So we'd agreed and exchanged contracts to buy a property in sort of mid 2007, which really, with the benefit of hindsight, was the absolute top of the market. And we exchanged with a delayed completion of about 6 months, and we had an offer of finance. At that time, the sort of 6-month period was to enable us to get the equity side of things sorted out. But in that 6-month period, the lender, who were a company called Salt Commercial, pulled out of the market completely. They were a subsidiary of Derbyshire Building Society, who ultimately effectively went bust. They got subsumed into the Halifax. So we ended up with a property we'd exchanged contracts on that was falling in value, that we didn't have finance in place. So we ended up having to buy that on bridging finance, and I think the bridging finance was costing us £10,000 a month, and I think the rent roll was £6,000. So that wasn't very good. And then, as I say, all the other as I say, in the early part of that period, base rate was still 5.75%, and we bought stuff maybe when base rate was 4.5%. So interest rates had gone against us, and we were losing, just in cash flow terms, about £15,000 a week at that point, until the interest rates came down and effectively sort of bailed us out of that. And I remember saying to somebody, we were lucky, but as somebody made the point, the whole point of pulling interest rates down was to save businesses, was to enable the economy to continue going forward. So so we were the beneficiaries of that policy, I guess. And having racked up a fair bit of arrears, I think maximum, we got up to about £140,000 in mortgage arrears. But through those next sort of 2 or 3 years, through to 2011, I guess we paid all of that off, got back on a really solid footing. And I think going back, our focus has been on buying the next property and the next property, and not on the proper management of the properties and KPIs and all that stuff that I'm hopefully sort of a bit more all over now. And one of the consequences of that is, and the adverse cash flow, was that we had a fair number of properties that were empty and needed money spending on them. So we got through to 2012, and at that time we had a monthly surplus of about £10,000 that we could roll into the refurbs. So that was where we were, and in probably 15 to 18 months we would have got everything let and all on a firm footing. And then so about half of our debt at that time was with Northern Rock, and they'd effectively gone bust. They'd been subsumed by the government under an umbrella company called UK Asset Realisation, which owned Northern Rock. It owned the government's shares in RBS, because they bought a lot of shares in RBS to bail them out. It owned Bradford and Bingley. So it was this sort of holding company for all those distressed assets that the government had acquired. And I had a letter from a chap at Northern Rock in sort of early 2011 saying, "I'm your new relationship manager." Now, I knew that those loans were due to come to an end in 2015, that we were probably underwater on them, and that that was something I had to be aware of, I guess. So I immediately got back to this guy and said, "Thanks for your letter. It'd be good to meet up at some point just to review where we are and try and project forward to 2015 and see what the options are, in order to sort of trade out of this position." And I never heard back from the guy for about 18 months, until September 2012, when I got a letter saying, "We've revalued all your properties," which I was aware of, at our expense, of course, and that you're in breach of your loan to value covenant. So unlike a lot of standard buy-to-let mortgages, don't have buy-to-let covenants in. So they'll have loan to value covenants. They'll have a loan to value day one, but if then the property value comes down, you're not in breach of anything. Whereas Northern Rock loans were more of a commercial style, albeit on residential properties. So they had a loan to value covenant, which basically says, at all times you must ensure that your loan to value does not exceed 80%. And based on their valuations, which were a bit pessimistic, but you can never argue with these things, we were sat somewhere slightly north of 100%. I think it's about 105, 106%. So they said, "You're in breach of your loan to value covenants, and we demand immediate repayment of the £6 million you owe us." So I picked up this letter, having got home one evening. I can remember it vividly, on a Thursday evening. Picked up the phone the next morning to this guy and said, "You'll not find it terribly surprising that we don't actually have £6 million, just sort of sitting around that we can repay you with. So it would seem sensible to meet, and see where we all sit, and see how we move forward from here." And basically the guy said, "Well, unless you've got a big chunk of money to reduce your loan to value, there's nothing to discuss." And over the course of the next sort of 3 or 4 days, I sort of was firing email at this guy saying, "Look, if you take these properties in receivership, there's going to be impaired value, and we might be better off looking at if we can possibly refinance them and at least pay you some of the money. and this was in a period where a lot of banks had been accepting, and I think Yorkshire Bank at one point, because they wanted to go out of the market, were accepting 50p in the pound. So, was there an opportunity to do something? And I just couldn't get any traction with this guy at all. And then the following Thursday, so a week later, I was actually at dinner in London, and my phone buzzed in my pocket, and I quickly looked at it, an email from this guy saying, I just thought I'd let you know out of courtesy, we appointed LPA receivers across all your portfolio this afternoon. So, big deep breath, right? Where do we go forward from here? Because, effectively, unlike sort of owner-occupied property where, I have to serve notices and go to court and get a court order, with anything that's not owner-occupied, and this actually applies to all buy-to-let mortgages as well, is they, if you are in breach of the terms, and normally from an arrears point of view, it's 2 months arrears, they can just appoint receivers and basically take control of that property. Mm-hmm. And the receiver then looks at it and decides what to do. So we're then in a position we've got LPA receivers. But I guess if that had happened in sort of 2007, 8, 9, when we were sort of massively underwater and nowhere to go, I think maybe I'd have just rolled over and accepted it. But I thought I haven't battled for the last 5 years to get us back into what I thought at that time was a really strong position, only to have the rug pulled from under us. So, but as I said, I'd spent a week trying to get some traction with this guy, and he just wouldn't listen to anything. So, and this is where your network becomes a massive value. I knew 2 people who ran what at that time was called National Property Group, which were a lettings and management agency. They subsequently became UMove, became very successful, and in fact sold out. But National Property Group, and I knew from conversations I'd had with them that they were managing a couple of portfolios for sort of Mortgage Express, which was part of Bradford and Bingley, which is all part of the UCAR umbrella. And they were running those as sort of almost quasi-LPA receivers. So there wasn't a formal receivership, but there was distress in those portfolios. I think one was a couple and the husband died and the wife didn't really know anything about the portfolio, and it was underwater, and I can't remember the story behind the other one. So I knew that they were sort of, as I say, operating as quasi-LPA receivers without that formal thing where they got full transparency to the lender, they were reporting everything to the lender, but the properties remained within the ownership of the borrower, and any excess was being used to pay down the debt. And I thought, well, given that that's in place elsewhere, albeit with Mortgage Express portfolios rather than Northern Rock, maybe that might be an option to persuade, Northern Rock, not to proceed down the receivership route. So, as I say, knowing how hard-headed this guy was, what I did, I got back. So I'd been in London, got back on the train to Darlington, got out, was sat in the car. So I phoned the guys at National Property Group and said, look, this is what's happened. What I'm going to do, I'm going to set up a conference call and ring this guy. I won't tell him that it's a conference call. I'll just ring him. So I rang him and I said, look, got your email, obviously very disappointed. I'm sure there's a better way of dealing this. And I have on the phone with us now, 2 people who are already managing portfolios for your broader organization. And we were able to have a conversation, which I hadn't been able to do before. So by using perhaps a little bit of subterfuge, mm-hmm. We started to get some traction, and we also had a number of properties, about 20 properties with Mortgage Express, where there weren't loan to value covenants, so they couldn't do anything about that. But I suppose the carrot, we said, look, we'll chuck these in to the same management arrangement, so you've then got sort of full control of the portfolio. And over the period of sort of 2 or 3 weeks, we managed to get that in place and get the receiver's appointment cancelled. And to this day, I still haven't come across anybody who's managed to get LPA receivers cancelled. So I sort of regard that as quite a sort of feather in my cap, I suppose. And then we had a period of about 6 months when the properties were being managed by National Property Group. And the challenge with that is, at that time, I guess our tenant profile was more towards housing benefit. Not massively so. I think it might have been 25, 30%, and now it's well into sort of single figures, probably 4 or 5% housing benefit. And and we manage the properties in a very hands-on way. We've got quite a lot in one area, and National Property Group, as well as obviously charging management fees, which were coming off the rent, and arranging maintenance, which was at a greater cost than we were doing it because we had sort of in-house maintenance. And so they were good enough after 6 months to go to Northern Rock and basically say, look, we don't think we're achieving the results from a management point of view as was happening before all this happened, and indeed we're just adding costs. So really the best thing you can do, Northern Rock, is allow the borrower to step back in and manage these properties, and that's what we did. But through a period of 6 months, obviously massive cost had been added. Some tenants had left or run up arrears because the receivers write to all the tenants. We had tenants arriving in the office with letters saying, well, what's this about? So we just said, oh, that's nothing you need to worry about, and probably put it in the bin. But some of them had stopped paying rent or had left, or so that period caused having been in a very strong position, that caused a sort of massive upset. And I guess until probably 3 or 4 years ago, we've then just sort of bumped along really. Because in the Northeast, we haven't had any rental growth. We've had very little capital growth until probably 3 years ago. And then we've just started to get, quite decent increases in rents, slowly increasing capital values. And that's been great. Unfortunately, a lot of the debt's still on floating rates, and therefore the interest rates have more than outstripped the rental growth, unfortunately. So we're now in a position where we've had massive increase in sort of interest costs, and we're doing a bit of over the years we've sold off a few. As I say, we were up to nearly 200 at one point. We're down to about 170, and we're selling off a few properties now. And I think the big difference with sort of where we sit now will be that because of the interest rates, we're not in a great position overall. Most of the properties have got a decent chunk of equity in, so we're able to, whereas back in 2007 we'd leveraged those up to the hilt and then they'd gone down in value. So we had it wasn't worth selling anything because didn't have any money in it. Whereas now we've got a decent chunk of equity, so we're selling off a few at the moment just to, I guess, sort of rebalance the books and stabilize things. And also, as you mentioned, about 7 or 8 years ago, we took 18 flats, apartments in Sunderland within our portfolio, started doing short lets with those, and that's been very good. We certainly make the way we sort of manage that from a financial point of view is to look at what profit we're making over and above the rent which we would otherwise get. And you get some months when it's slightly below, but you get some very good months where we're probably making on top of the rent, the really good months, maybe an extra £10,000. So that's been very good as well. So yeah, rather long-winded, but that's the I suppose the fairly full. I mean, there's all sorts of stories I could tell sort of along the way. Actually, I'll tell one because it's just quite funny, really. So we had a bunch of properties that the mortgage has been sold a number of times, and we were in a small amount of arrears with them. And interestingly, when the arrears occurred, so I don't know, let's say the mortgage payment was £500 a month, and we made sure they were under the 2 months. So we might then be, £950 in arrears, and that was less than 2 months. Interest rates come down, so the mortgages then say, I don't know, £200 a month. So the lender says, oh, you're now, nearly 5 months in arrears, albeit it was less than 2 months when it occurred. Anyway, so they, interestingly, they didn't go down the LPA receivership route, but they served possession orders on us and went to court. And I think it was across about 11 properties. And we went to the first bunch of properties, and I had written to them saying, look, we can pay this off in 3 months or something, but they weren't interested. So we ended up in court. So the first 3 were in Gateshead, 3 properties. The lender had appointed a local solicitor. So she said to me before, look, what's your position going to be? And I said, well, look, we've said we can pay this off in 3 months. And that's what I'll put to the judge, put to the court. So she said, okay, well, we're going to go for possession. Seems bizarre, really, but there we go. So got in front of the judge, and he said, right, Mr. Living. So in order to, I suppose, frame my proposal, I said, look, if we were to pay an extra X, these arrears would be cleared within 12 months. And he said, yes, thank you, that's fine. So the solicitor for the other side said, no, but Mr. Living is going to offer something different. And he said, I don't care. That's absolutely fine. I'm prepared to accept that. So having said I would pay it in 3 months, the court then agreed we could pay it over 12 months. So got those. So lo and behold, the next one, obviously we dealt with all three. Oh yeah, okay, we'll do that over 12 months. The next one. Next day, we were up in, I think it was Morpeth, and I think we had a couple of properties up there in front of the court. And lo and behold, the same solicitor turns up to act on behalf of the lender. So so she said, yeah, what's your position? So I said, well, based on yesterday, I'll go for 12 months. And we get into chambers, and it's the same judge who'd been sitting in Gateshead the day before. So I smiled to myself and thought, this is going to be quite easy.
Yeah.
Yeah, it's one of those little.
Well, look, the lender got their money back,
Yeah,
and
absolutely.
so you would imagine they would be fairly content about that in the grand scheme of things.
Yeah. And,
well, I kind of positioned this by explaining that you had a pretty remarkable story and a depth of experience, which is why I wanted you to tell it in its fullest, because I really think there's a lot of value in there. Now, clearly, the obvious question is to immediately get into kind of lessons learned, and I'm sure there are lots of lessons, and I'm sure there's at least a couple you'd share with us. But there are a couple of points I just want to kind of hover over, because I think there's genuine value in them. The first of which is fairly flippant, which is, you say, you moved to Yorkshire for various reasons. No one needs any reasons to move to Yorkshire. You know that it's God's own county, and it's the only sensible decision that anybody can ever make. So we can move quickly off that. On a more serious note, I mean, you talk about kind of your seed capital coming from friends and family. My perception is that people think that they need a million investors, and who all have lavish yachts and all the rest of it. I'm making an assumption here, but I'm assuming you didn't have a black book with a million different investors in it. I would imagine, and obviously correct me if I'm getting this wrong, you've maybe a handful of people who had a sufficient amount of knowledge, trust, and confidence in you that they were willing to take that early risk. Yeah, I would imagine that's the case. How far off the mark am I?
Yeah, no, one at the beginning.
Yeah.
And not really much, as any odd bits at various times since then. And I think, okay, you could say having had that seed capital, we would then have the benefit of a rising market. But even so, I mean, one of the things that I think is so interesting is how much money there is out there. A lot of which is sat in the bank at 1.5%, 2% if you're lucky. And those people just don't know any different, really. There are all sorts of people with 50, £100,000 just sat there that's their nest egg, and and don't take these things lightly. You've got to be really respectful and very careful with that money. But if you're then delivering 6, 8, 10% to somebody, that's a massive benefit to them. And enables you to move forward.
I like the word you use there as well, which is nest egg, because I think that communicates the importance of it as well. These are not trivial amounts of money, and you hear people talk fairly flippantly in the wealth creation space around money, around losses they may have encountered. But when you are dealing with someone's nest egg, you have to treat it with that level of respect, don't you?
Oh, absolutely. No, 100%. And I think probably over the last 10 years, I think one of the things I haven't done is do a lot of that sort of JV investor stuff. And looking back, I think, is that perhaps something I should have done? And I think it's something I want to look at more closely going forward. But I think a significant reason why I haven't is because, I've been, I don't know, whether fearful isn't the right word, but apprehensive or just very conscious of the fact that that is someone else's money, and I want to be able to, and through a period where, for heaven's sake, we've had a massive roller coaster moments, I'm then thinking, I don't want to expose someone else's money to that. So I need to make sure I've got all my proverbial ducks in a row, before I start.
And equally, when you were growing this portfolio, the landscape was very different. There were very different financial products available, and that's, so there were different strategies in that particular period of history, weren't there?
Yes.
And if we can just kind of delve into that then. So you ended up with Northern Rock. So Northern Rock, were famous for many things, one of which was that, they'd let you get to about 110% leverage on a first loan, and all kinds of interesting and exciting things like that. Just in overview, so how did you scale using the sort of novel, innovative financial products that we had in that chapter of sort of investment? Were you taking out individual buy-to-let loans, or had you negotiated a facility with one lender that, they had the charge over the whole portfolio, or were these still individual loans?
So a mixture. So the Northern Rock stuff is, we've got some properties in personal names, some in limited company. So there are 2 portfolio loans with multiple properties beneath them, and we had similar arrangements. I think initially with Bank of Scotland, and then we refinanced. And I think it would have been 2005. We refinanced away from Bank of Scotland to a mixture of Northern Rock and RBS. And at that time, that was through a broker who had sort of strong relationships with both. And at that time, the plan was that all the existing properties went to Northern Rock, so put on term loans with them. And I was trying to sort of remember exactly how it worked, but certainly we had essentially a revolving credit facility, effectively I suppose a pre-marked overdraft almost with RBS, whereby we could buy properties into that, improve them, use that facility, and then move them across to Northern Rock as and when we got them revalued at a higher rate. So and I think there are odd facilities like that about, but they're a bit few and far between now, understandably. It's changed somewhat. But going back to Northern Rock, so Northern Rock, we could do 80% loan to value, which obviously is fairly high. But the really interesting thing looking back is that they only required 100% rental cover. Now, because we were buying high yielding properties, that actually was never a problem for us anyway. But just as a policy, so now typically lenders are requiring anything sort of 125, 145. So just to be clear for people perhaps who aren't familiar with that, your rent has to cover your debt servicing costs, interest costs by 145%. So if it was got to be, half as much again. Northern Rock would have been happy as long as your rent covered the interest, which just is nuts. I mean, it makes no sense at all. I mean, it might possibly make a little bit of sense with a commercial property where you're on a full repairing and insuring lease, so the tenant pays all the costs, so the rent you get is the profit, or the gross rent is the net rent. Whereas with residential property, the gross rent is never the net rent. So if you're, and these people are supposed to be sophisticated, clever, bankers and financial institutions. And I remember somebody once saying to me, don't beat yourself up about the problems you got into, because they should have been a far more sophisticated lender than you were a sophisticated borrower. So the fault lies not with you for borrowing the money, but with them, quite frankly, allowing you to create that situation.
And it was, obviously it was a particular point in history. So I've had people tell me, obviously in private, that their memory of the sentiments around that time leading up, to 2007 was that, this was never going to end. That if you didn't secure the property on that day, you'd be paying another £10,000 the following day in certain locations. And there was genuinely this almost hysteria around the fact that it's up only from here on in, and this is it. And if you didn't kind of claim your land, if you like, you were going to miss the boat forever. Do you remember that sentiment?
I very much so, and I think it was, the sort of general attitude is, as long as you could find somewhere funding it, just buy it. So there wasn't really the level of analysis or sort of critical thinking that there should have been. And again, going back to another lender, so Mortgage Express, which was the buy-to-let subsidiary of Bradford and Bingley, they would allow you to remortgage immediately the day after you bought a property at full value. Mm-hmm. So just to give an example of that, if you were able to find a property that you could get that, if that was genuinely worth £100,000, and you could buy that at, say, £75,000, they would lend you £85,000 the day after you bought it. So you would either, there were lots of facilities around for, just pay to someone 1% to have the money overnight, which mm-hmm. was good on an annualized basis for them. But there were people around with cash, or there were even lenders who would facilitate that. But literally you pay it back the next day. And as a result of that, you were effectively creating cash flow by buying properties. Because if you were buying a property for £75,000 and getting a mortgage for 85 the next day, okay, you've got some costs to come off that. But net, you were probably ending up with £6,000 or £7,000 in your bank that you didn't have the day before. Okay, mm-hmm. It was all borrowed money, but it was, in a literal sense, it was cash flow. Mm-hmm. And we bought, using that facility, that Mortgage Express facility, we bought 17 properties in 10 weeks. Mm-hmm. Just, and okay, to be honest, they probably, hindsight, they weren't necessarily bad properties, and we've still got quite a lot of them now. So, they were some reasonable buy-to-let stock, but just the whole, as you say, there was that sort of hysteria, and it was all about, as I said a bit earlier, it was all about buying the next one and the next one, not really about taking stock and are we managing this properly, and mm-hmm. and are we efficiently collecting rent? Are we efficiently carrying out repairs? Are we making sure that when a property comes empty, that we're getting that property turned around as quickly as possible and back out into the market? All those sort of things, which absolutely you should be doing. When someone hasn't paid £500 rent, but if we buy that property tomorrow, we're going to get £7,000 the next day. Where's your focus going to be?
Yeah, absolutely. And that's why I think context is really, really important. Why I think it's so important for, I think, for example, for this podcast, because I think it's really important for people to understand the context in which that market was operating. And we are going to turn on to lessons learned in due course, but, to allow that to kind of, go into the back of our minds. So if we ever see similar things, so for example, if you ever feel like you're a genius, I think this is a good benchmark. If you ever feel like you're a genius, pause for breath, mm-hmm. stop what you're doing, have a good look around, and then recalibrate as to whether you are in fact a genius, or whether there's some steps that would be wise to take at this juncture. Yeah. There's a couple of points.
I remember looking back and looking at properties we bought. We bought that for X, and now it's worth this, and aren't we terribly clever? Yeah. Some of them were genuine good buys. There's an HMO in Sunderland we've got, which we've still got now, and I think, and it was bought from a retiring landlord off market who I knew. So we had quite a lot in the same street, and he said, if ever I want to sell, I'll come to you. Came to me and said, what do you want? I said £90,000. Said, great, okay, we sorted that out. We had it valued at 180. But there's nothing really terribly clever I did. But at the time you think, you think, well, I've obviously just got the Midas touch.
but equally, to your credit, perfectly legal financial products. You were really going for it. You were taking risk. You were using, entrepreneurial spirit. So in no way am I diminishing what you were doing. I mean, it's a fantastic achievement. Appreciate problems then later came. I think also it's also for people listening who are, like people, for example, who attend my breakfast meeting and they see the achievements necessarily of others. I do try and stress context, because if you do have access to unusual and innovative financial products that were of their time, it's really unfair, I think, if you're just starting out in property today, to compare yourself to that person and say, why haven't I bought 17 properties in 10 weeks or whatever it is. It's, well, look, maybe the world is slightly different, and I think certainly don't beat yourself around the head with that. It was of a different time. There's a couple of points of detail that I just think would be really, 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 useful for us to just hover over for a second. So just in really layman's terms, because we've used the technical term, we've used LPA receiver. Let's just, in a couple of sentences, just unpack that out of the box so that people know exactly what it is.
Sure. So to unpack the technical terms, so LPA refers to the Law of Property Act 1925, and that is, whatever, nearly 100 years later, still the relevant legislation. And under that act, a lender, if there is a breach of the mortgage terms, may appoint a receiver. So it's slightly different from a company receiver in the sense you're not putting a business into receivership, you're appointing a receiver. And probably a better word is caretaker, probably. So the lender are saying, look, we're not, we're obviously uncomfortable with how this debt is going for whatever reason, whether that's because you're in arrears, you're in breach of loan to value, you haven't maintained the property, whatever breach has gone on. So we want to, so rather than us becoming mortgagees in possession, which is another route, so the mortgage company can actually step in and take title to the property. What we want to do is appoint a caretaker to that property. And the caretaker, the caretaker technically is independent. They're not technically acting on instructions from the lender. The reality is they sort of are more than not. And their job really is to look at that situation and say, how can we best protect the interests of all parties? And in most cases, they will look to sell the property, pay back whatever they can to the lender, and the lender will then come after you for the shortfall. There might be occasions, and there are occasions, when LPA receivers hold property for the longer term, and there may be some there may be some empty property. It may take on a, let's say, a multi-let office building or something like that. So what they might do is then, and there's a bit of surplus rent, so they might use that then to refurbish some of the empty units and then put people in to enhance the asset value, so that the lender then gets more money out of it at the end. So they have quite wide-ranging powers, but effectively they're there as a third-party independent caretaker.
So we've got the LPA receiver in place. I think one of the other, a little mantra that I have is read the contract. I really, if I could give it anybody in any situation one word of advice, one sort of sentence of advice, would be always just read the contract. It doesn't matter what it is. We're so used to clicking through and all the rest of it, but read the contract. So we've got the existence of the LPA receiver. And you referred also to something that I would urge everybody to seek out. And it's, when COVID hit, I was talking to people about this, when the interest rates were beginning to go up, and we were beginning to see a wobble. I was talking about this, is this loan to value covenant that you so ably described for us, which is, any point during the future of this loan, the loan to value must not exceed X. Or you can get a slightly nastier version, can't you, which says, we're going to come back in 3 years' time, and if the loan to value isn't 65, for example, we would like you will give you 2 weeks to bring your account into order, which is obviously a thrilling prospect for everybody.
Yes.
To add to that, we've also got to look for those terms and conditions that, in my experience, are in all lending documents, which is, if we have to take any action pursuant to enforcing our rights, you will pay, on an indemnity basis, you will pay for
all the costs. Yeah.
So that can obviously be, as you've described, valuations. So the lender has their perspective on something, and at their pleasure, if you like, they send out a chap or a man or woman to come and value it, and then they send you the bill for the valuation afterwards.
Yes. Yeah, no, exactly. I mean, I think when prior to the receivership action, when we had the properties revalued, I think it was the thick end of £10,000 of valuation fees.
Unbelievable. When you're right in the thick of it already.
I think I did persuade them to add them to the loan on that occasion, but most of the time they're going to want that to come out of your pocket.
Another point as well, I think, just to highlight, for those that weren't there at the time, is the impact of floating rates. So obviously people took out really favourable floating rates at that point in history. There's still some of them around today. And I have, anecdotally, people who have, ridden that wave have told me that it was absolutely astonishing when interest rates started going up, because they went up so quickly and to a certain extent, and people just hadn't encountered it before, who were investing at that time. And they talk almost of like the trauma of the experience of seeing the cash flow of their portfolio just evaporate overnight. And let's be honest, we're seeing a similar set of circumstances now, with rates being as high as they are now. I appreciate that in global terms that then in no way astonishing, but they are much higher than historically we've become used to, with, like the boiled frog, basically, where we're so used to these low rates. And lots of investors and indeed homeowners are popping out of lovely discounted rates onto variable rates and getting the shock of their lives. And that includes, people who are, you could say that property investors are speculators. Let's put them in one camp. But you can also talk about young families who have tried to play the game, try and get themselves a house. Maybe they've taken on too much debt, but that's because that's the nature of the beast. And they got their mortgage at 2%, and then it flicks onto the variable rate of 6%, and they get the shock of their lives, and they're trying to, so can you share a little bit about your experience of that when rates began to increase as we went into that financial crisis, and what impact it had on you, what impact it had on your cash flow? What was that experience like?
Yeah, so as I was saying, I think, and I can't remember the exact figures, but certainly we were down at, if we weren't below 4.5, we were certainly down at 4.5 at one point, probably in 2006-07, and then by mid 2007 we were up at 5.75. So yeah, so a lot of those properties we bought and stacked them off a variable rate at 4.5, plus a margin, and then all of a sudden you're paying 5.75 plus a margin. When you've only just bought those properties and maxed out the borrowing on them, clearly any profit you thought you were making, rapidly disappears. And even, I guess, it probably was exacerbated. So at that time, it was not uncommon to get trackers with an initial discount. So on some of them, you'd be paying one below base, or even I think up to sort of 1.5. So actually, so you may have started at 4.5 lesser percent. So you may have been 3.5, and then when you come off that, you're at 5.75. Plus anything up to 2%. I mean, our variable rate trackers that we've still got sit anywhere between 1% and 2%. So you could have gone from 3.5 to whatever that is, but 7.75 at that time. And when obviously when you're interest only, that is your hard cost. So all of a sudden your interest cost is doubling, and you bought this nice property on the basis that the rent was 500 and the mortgage was 350. And then all of a sudden the rent's still 500 and the mortgage is 700.
Yeah. And then maybe the rent isn't 500, maybe the rent's 0 because you have a tenant who unfortunately, loses their job and for, reasons beyond their control isn't able to pay their rent. And obviously you've got to make sure that you comply with all your obligations, haven't you?
Yeah. And to, now one of the reasons we're selling, a few properties, just a bit of rebalance, but we've got properties now where the mortgage is close to or in excess of the rent.
Right.
Even with the growth we've had and all the rest of it, there's still. I mean, one of the fascinating things in terms of sort of reviewing our portfolio is the vast majority of our property we've now got some equity in, but there are a few. There's probably a handful in there where you look and you just think, how did we ever get a valuation at that level in 2006, 7, whatever it was? Because it's even today it's either not. I mean, some of them you think, well, I just an example. I think we've got a flat that's it's probably worth about 50-55. I think the debt on it is 75. So we must have had a valuation at 90 or something. And you just think, we weren't, there's no brown paper envelopes or arms twisted or anything like that. That, it was just how it was. As you said, we were just, it was a massive bubble.
And obviously there were consequences of that for the valuers as well. So when, understandably, property investors talk with frustration about the way the valuation system works. Like I always try and be, as balanced as I can in all things. I do point out that post, the great financial crisis, the first port of call for the lenders was they knew the borrowers weren't able to kind of go good on, turn good on their covenant. They knew there'd be a shortfall because there's always going to be a shortfall, especially when you chuck in all the expenses as well. So the natural port of call was professional indemnity policies that the valuers had, and a whole industry arose around that. So when a valuer turns up and he or she is a little bit nervous about the valuation that you want, the reason for that is that industry, and I'm not, playing the violin for them, but that industry paid the price along with a lot of other people with professional negligence claims.
Yes, yeah, and okay, ultimately to a significant extent, maybe their professional indemnity cover picked up that, but often professional indemnity cover often has quite chunky excesses, and also what you now find, and the bleat of them, is that their professional indemnity premiums have rocketed for that reason, because the insurers, okay, they ended up picking up a lump of it, but the insurers ended up picking a lump of it as well. So,
and I know it is a fact of professional life, but having a claim against your professional indemnity insurance is unlikely to be good for your career, at least in the short term. So anyway, there's so many more things I could ask you about that, but I am conscious of time, and I do want to draw out a couple of other things before I let you go. So there are so many lessons that we could learn from this, but could you give us 2 or 3 of the the absolute most important lessons that you think we can all take away from your experience? I could put it another way and say, if you had your time again, how would you do it differently? Take it as you wish, but like what are 2 or 3 of the absolute solid gold things you'd take away?
Sure. I think the first one is not so much, well, I suppose it is a takeaway, but it's equally a bit of advice to people, and it's something that I really try and say to people, and that is that on your property investing career, call it what you like, things will go wrong. Something will go wrong, and I think it's so easy to turn up to networking meetings and see someone at the front who's been at this for 3 years, and either they've got lucky and it has all gone right, or there's a bit of economy with the truth, shall we say. But it's presented as nothing ever goes wrong. I've got this HMO, I spent 20 grand on it, it's worth £100,000 more, it's cash flowing this and all the rest of it. And I say to people, just mentally be prepared for the fact that something will go wrong, because I think if you're not, you're jogging along in your little property career, and all of a sudden something goes wrong, and mentally that can be very difficult to cope with, because I think you blame yourself. You say, well, look, everyone else I speak to, they're all doing fine, and on Facebook they're all marvelous, and when I go to networking meetings, nothing ever goes wrong. And I therefore think to say to people, it will. I can't tell you what it is or when it will happen, but just be mentally prepared, and the fact that you can get over it, but things will go wrong. So I think that's just a really important thing to say to people. I think the way I have got through stuff is just to have that never give up mentality, and that it has been massively challenging at times, and I think when I've been really in the weeds of difficulty, I think the attitude I've taken is simply almost what can I do today, but almost what can I do in this minute just to move forward. Don't worry about next week or the week after, or if it all go, because I think to project too far forward. I remember going to a meeting, somebody had introduced me to some insolvency practitioners in Leeds. And they said, come and have a free meeting, we'll have a chat and we'll review everything. And their view was, you're going to go bust. So you need to prepare for that. And mentally I couldn't go there. And I couldn't, it's like if you chase 2 rabbits, you won't catch either. So I didn't want to chase the bank. I didn't want to think about bankruptcy, because if I started to think about that, how can I focus on, climbing out of the hole? and as I say, it was on a day-to-day basis. What can I do now, today, in this minute, just to move things forward? Rather than thinking too far ahead. Now, in the wider picture, yeah, we need to be thinking 5-10 years down the road, and what do we need to do now? But in that really difficult moment, I think my advice and what I did was just to do whatever you can on that day to whether it's to bat a problem away or to make a bit of progress with something, because it's just so easy to get overwhelmed in those circumstances. And certainly I did at times. But I think just to move forward, cash flow, I guess, in terms of what goes wrong, cash flow is, in a sense, is always the key. And one thing I would say to people, if you've got a rental portfolio, make sure you've always got a cash buffer, some working capital, so that if you do get a property comes empty and it's been trashed and it needs 10 or 15,000 pounds spent on it, that you've got that money there. Because you might have a nice portfolio of, say, 20 properties, and you think it's a decent number of properties, a decent portfolio, it's all going well. One comes empty and needs 10-15,000 pounds spent on it, and you haven't got it in the moment. And then all of a sudden another one comes empty. That's now 10% of your gross income, and you can guarantee that that's a much higher proportion of your net profit. So to have that cash buffer, and once you've spent it, make sure you build it back up. And we did have a certain amount of cash, but it was, I suppose, never going to be enough in the circumstances we found ourselves in. But as I say, we'd focused on buying more, rather than really looking after what we've got. Yeah, so there's so many things. Systemization is a huge, certainly if you want to grow, quite frankly, any business, beyond you running everything day to day, you've got to start to put systems in place, because it's the only way to delegate. And I think one of the things I did, through that rapid growth period, is started to sort of bring people in and started to try to delegate, but quite frankly, I didn't know how to delegate, and so it tended to be sort of abdication, rather than delegation. And a book I would massively recommend to anybody is The E-Myth Revisited by Michael Gerber, that very much talks about that story.
I think they're excellent learning points there. Want to hover back on, if we can, is the idea of this cash buffer and making sure that you're in a position to do that. I suppose to take that a little bit further, would you, and to seek your view on this, what's your view on, from time to time, having periods of consolidation, letting the business catch up with itself, let the coffers refill? Because I know we all, particularly when you get the taste for it, you're going from transaction to transaction, you've got the kind of wind in your sails, so what's your view on having enforced periods of consolidation?
Yeah, no, I would massively agree with that. I think go in steps. So as you say, you go up a step, and in a graphic sense, level out a bit, consolidate, as you say, maybe you get your LTV back down, maybe even sell one or two to achieve that, before you go again. I think, and I think again, I became wedded to the idea of having a bigger and bigger portfolio. And okay, we did buy and sell some stuff along the way, but really, almost the sort of business identity became about having a massive portfolio. Actually, what you want is a portfolio that cash flows. Definitely. Really. And okay, it was always, well, the more we've got, with gearing and capital growth, it'll be worth that much more at the end. But that's no good if you don't cash flow it in the middle, because you'll never get there. So yeah, and the other thing, which really is something that's really only been brought home to me probably in the last, I would say, almost a year, 18 months, and that is, I think, in an ideal world, if you're investing in property, you want a cash flowing business sat alongside that. That might, cash flowing business might be a full-time job. So there's plenty of people in this world who enjoy what they do and are very well remunerated for doing it, but they want to grow property as a bit of a long-term or an early retirement pot or whatever. But even if you're doing it full-time, if you can have a cash flowing business, and that may be a non-property business, but that could be, I don't particularly like the term sourcing, but a sort of an acquisitions business. It could be a letting agency. It could be it could be something property related or non-property related. But in an ideal world, if you've got a cash flowing business that pays your basic bills, then you're not dipping into the property pot the whole time and denuding that. And that absolutely is, I think, if I had my time again. And I, in a sense, I almost started going down that route with the buy to sells of saying, look, got a load of property, and sort of 100 units or so, let's do some buy to sells, because that creates better cash flow. And then really, I guess, because of the availability of finance and to be honest, just getting caught up in that, buying more and buying more, somehow my attention got diverted from doing that buy to sell. Okay, buy to sell is a bit chunkier, but if you're doing a regular stream of that, that could be your cash flowing business. You could have a buffer in there so you can sort of pay your bills out of that, and every so often 20,000 or 30,000 drops into that, and then you're drawing £5,000 a month or whatever you need. But you're leaving the rental properties alone to accumulate, potentially. And I would also say, in terms of periods of consolidation, is fine to go interest only to begin with, but then get to a point and maybe don't turn it all over to capital and repayment, but maybe have some capital and repayment going on. And whether that's formal in sense you've got capital and repayment mortgages, or you just pay down your debt. And I know that runs contrary to what a lot of the gurus whatever say about all interest only, never pay off any debt. At the end of the day, what would you rather have? What would you rather end up with? Sort of £10 million worth of property and £8 million worth of debt, or £2 million of property and no debt? And I think most people would be more comfortable with the £2 million of property.
Definitely.
But we all get sucked into that.
I think particularly, when you get to that stage of life where, maybe you're thinking about legacy, maybe you're looking, looking at what your children might have to deal with and all the rest of it. And even in situations where, let's say, you're in a loving partnership and one of you's the property person, but actually the other person isn't the property person. No. And actually, to be honest, they'd be pretty horrified if they get an absolute monster to take care of. I think that's all. I think that's all really excellent advice. I really do. Conscious of your time, and appreciate you being very, very generous with your time, and also with everything you've shared with us so far. Can we just try and get in a couple of quick fire things, and then we'll move on to kind of where you're going next, how people can connect with you, what's kind of important to you now. So just, I suppose, two quick fire things. Let's get two avatars of two different very extremes. And I appreciate that, full disclosure to listeners in advance, I appreciate that not everybody's going to fit these avatars at all, but these are just for the purposes of illustration with Jason. So let's say you've got somebody bags full of energy, willing to do the grind, got a couple of years of grace, if you like. So let's say they've sat down with their relevant other, and the relevant other has said, look, I can see you want to give this property thing a go. I'll back you I'll back you for a year, but we really need this to work. Otherwise you're going back, you're going to have to go back and get a job. And by hook or by crook or some miracle, they've got access to, let's say, £100,000. I appreciate that's not a trivial amount of money. I appreciate it's not a trivial amount of money. Not giving in financial advice, but give us a flavour of, if you have bags of energy, time, graft, and access to the beginnings of a six-figure sum, what direction would you go in?
I think let's look at it from a property perspective. I think in some ways a sort of obvious answer might be to sort of do the buy, refurb, refinance and rent out. But I think even that, okay, you're recycling your capital, but there's only so many projects you can do at any one time. With £100,000 pot, you might be able to have a couple on the go, but they're going to probably take 3 to 6 months to work through. So at the end of your 2 years, you might end up with 6, 7 properties, and that's not going to create a whole load of cash flow, really. So I think if I was looking at it from a point of view of within a 12 to 24 month cycle, generating if you like a job's amount of cash flow, as it were, maybe at a minimum, say £25,000 to £30,000, I think done right, and there are people who get it wrong. The term rent to rent is used. I far prefer leasing, but a leasing model of, say, serviced accommodation. Now, one thing I would say, and I always say to people, is serviced accommodation short lets is a trading business. It's not a property strategy. It happens to have a property involved in it, but it is a trading business. Just in the same way, so people, Travelodge do exactly the same. They don't own the buildings they occupy; they lease them. They're not but you wouldn't say Travelodge are doing a property strategy, whereas a lot of people doing, as it's termed, rent to rent SA, say it's a property strategy. I would fundamentally disagree with that. It's a trading business, but it can be a very good trading business, and I know people who've done that very successfully, and I know people who've started at that point, and then as they've built that, well, even I've known people who started at the management levels. They start managing short let properties on behalf of other people. They then do some leasing of those properties, so they're taking the risk. They then get to a point where they're generating enough property that they can start to buy one or two. And I think, if you had that time and energy, and don't get me wrong, it requires a fairly thick slice of both. I think if you were looking at as I say, a property-based business or a property-style business, and it isn't really a property strategy, I think that would be something. What I say to people about service accommodation, there's an awful lot of moving parts, compared with a tenancy, where there's a bit of work to put the tenant in, and then ideally, if you've got the work right and the property right, the rent drops in every month, and you don't hear from them for 6 or 12 months. Doing short lets is nothing like that. So you definitely need the sort of enthusiasm, time, and energy to do it. But I think if you were looking at something that could create a decent amount of cash flow over a relatively short period of time, with a chunk of equity at the start, I think that would be a really good way to go.
Very good. And I mean, almost a strap line that I keep on hearing from experienced practitioners in the service accommodation space is, you're not in property, you're in hospitality. Yeah. And that's the name of the game. And then if we may just look at a second avatar, so somebody perhaps a later stage in life, whatever means, perhaps the redundancy or the divorce or just a change of life in some way, and they've got a bit more of a substantial pot, let's say 500 to 700,000. They don't have the energy for some of the harder yards, and also they're in that stage of life where they cannot tolerate a loss of a complete loss of capital. Like, that would be it. What, again, not giving financial advice, but what direction would you send somebody in who's in that position?
I guess there's 2 or 3 things. I think certainly with interest rates having gone up, there's some quite decent commercial properties available, that you might be yielding, sort of up towards double digits, up towards 10 or even 12%, where you've got people on a full repair and insuring lease. So what that means is effectively the tenant pays the outgoings of the property, they have to repair it, they have to pay for the insurance, and therefore the rent you receive is the rent, and you've not got outgoings on that, assuming you're not gearing that money, and that's an option, but obviously that there's a risk return there. But if you were looking sort of pure cash investment, maybe something like a small industrial estate with multiple units, so you're spreading your risk. Okay, you're at the riskier end of the market than buying a nice sort of shiny office building with one tenant. But hopefully you've got multiple tenants. So that would be one route. I think another route is, as I say, very much not financial advice, but something like sort of crowd property, which I think is paying around sort of 10%. And coincidentally, I happened to meet Mike Bristow, who's the CEO of Crowd Property, last week, and he was saying, and I think I'm right in saying that they have some potential losses set within their portfolio now, but what he said is they have never crystallized a loss. So where they've got some perhaps more difficult loans, they're being worked out, but their model is very much to spread money across multiple projects. And even they've got quite a lot of institutional capital now, And it's not a case of that institutional capital coming in and saying, right, we'll fund that project. You know, there, and yeah, he was telling me all the metrics, but even the, you know, the big investors, you know, have a small slice of multiple projects. So even if a couple of those go wrong, you know, so it's, as I would perceive it, you know, relatively low risk. I'm sure it's in many ways perceived as high risk, but they come across to me as an extremely smart outfit, and you know, they've you know, grown massively from a pure crowdfunding model to now having institutional capital. So, so you know, something like that, you get a decent return. So, you know, commercial, maybe something like that. And then if you wanted to maybe generate some income at slightly higher risk, I think I would look at some of the things like managed forex funds. And okay, you know, you are talking obviously greater risk, but you know, there do seem to be funds that have consistently over a long period of time, you know, delivered decent returns within that, or that sort of stuff. I mean, I've never gone down the crypto route, just because I've always had a mantra of don't invest in something you don't understand. And despite the fact that I've read various articles that say, oh, everyone says they can't understand it, but I'll explain it really simply, and I get to the end of the article and say, no, I still don't understand it. So, you know, and that, yeah, to me, crypto is pure speculation. So to say, okay, all those three things I've said are towards the more riskier end of than, you know, chucking it in the bank and getting 1 or 2%. But I guess I'm looking at it from the point of view of how could you generate a decent income,
yeah,
you know, in a pretty hands-off fashion from that sort of money. And I guess I'm sure there are all sorts of other things. I can only talk about the things that are, you know, within my.
Well, no, I'm only interested in the things that you feel you can comment on, and not that I need to do this, but let's just underline for one more time: none of this is financial advice, and you know, in no way is Jason liable for any acts or omissions, etc., etc. So that's really helpful.
Professional indemnity cover for podcasts.
I am going to sneak in a little bonus question if you don't mind, because it is top of mind, which is which came up in a group, and it came from somebody who I have enormous fondness towards and enormous respect towards in the property industry. Very much, you know, self-made, huge respect. But they were sharing with a group that they felt they lost their property mojo. Any words of wisdom for somebody who may have lost their property mojo?
Yeah, I don't think I've ever lost my fundamental belief in property as a good thing to be investing in, certainly for long-term wealth. I think yeah, it's been challenging at times, and at times you think, wouldn't life be easier if, you know, or you know, sometimes I think, oh, if it had all gone pop in 2007-8 and I'd sort of started with a blank sheet of paper, I might well be better off now. But I guess the way I look at it is that, you know, hopefully over that time I've learned all the things that, well, not all, you can never know everything, but learned an awful lot of things that would mean I would do it differently. So I would still absolutely say to anybody that property is a sound thing to get into. I would just say, you know, people always say learn from your mistakes, and as I always said, that's great, do learn from your mistakes, but what's a hell of a lot cheaper is learning from other people's.
Which is hence why we host podcasts like this.
Absolutely, yeah. And why I'm happy to, you know, to share this stuff. You know, you do sometimes feel a bit of an idiot looking back and thinking, well, why did we do those? But you can only ever do what you think's right at the time. And as you said, very different environment, you know, very different context, and you know, that was how it was at the time.
And you know, hindsight is a wonderful thing, isn't it?
Yes, if only.
So bringing things to a conclusion. So so in terms of your direction of travel, like where do you go next? Like, what's your focus at the moment? What's on top of mind for you at the moment?
Yeah, so a couple of bits and pieces. A while ago, I did some serviced accommodation events and some serviced accommodation training, and you know, I really enjoyed doing that. and I suppose that sort of faded for no particular reason. And then we had the whole COVID 3 years when most of those things were sort of largely shelved. But recently I picked up with somebody who you also know, Chris Carpenter, who's a very experienced investor and developer in sort of Leeds Harrogate area, and we coincidentally both arrived at the same point, that we felt we wanted to offer some training to property people, really at I suppose the sort of what I call sort of next level. So we're not looking for the people who are just coming in and getting started. Really, people who've perhaps been involved in property for 2 or 3 years, have a few properties, or have some experience. So one of the guys we were chatting with recently is a contractor, so has done quite a lot of development, but for other people, and really to help those people, I suppose, take their business through the next level in terms of getting involved in larger projects and development projects, and scaling their businesses and making sure they've got the foundations in and systemized. So that's something we're focused on delivering, and we're running a number of sort of one-day, I suppose, introductory events, and then we plan to start a 12-month mastermind with a group of people from those events. We'll also be putting on some webinars, hopefully in the next month or so. We're just pulling that together. And then in terms of my own, I guess, a bit of rationalisation, a bit of getting rid of some of the properties that sort of no longer make sense, or there's a decent chunk of equity and we think we can do something better with that equity. But fundamentally, to maintain a decent sized portfolio, continue with the serviced accommodation we're doing at the level we're doing it, which is 18 units, and that's in Sunderland, and we're happy with that. One of the other things, we self-manage all of our own properties, and I've sort of flipped and flopped over the years about whether we grow that into a letting agency, and I really think that is the right thing to do now. Whether we just do that simply with what we've got, or whether we merge or acquire another letting agency and use that as the sort of vehicle to grow that. And I think the advantage of that, I think, particularly if you're in the north where rents are lower and therefore the fees you're able to generate are lower because they tend to be percentage based. It's not a high margin business, but it's effectively largely repeat custom from month to month, and therefore you've got secure income. I think it's something we can grow. But to me, it's also off the back of that offering sort of acquisition services and other services to people. And going right back to your point about number of investors, I think people get into that. I really just don't like the word sourcing. And I think that's where to me, I'm offering an acquisition service, and that's very much more bespoke and individual. And I think going back to your point about number of investors, if you want to do it, you don't need a list of 10,000 investors. You probably need half a dozen who you've got a strong relationship with and are ready to go at any one point. And I know people who have very, very successfully run acquisition businesses over years and probably never had more than 20 clients, as a total, and probably only 4 or 5 active at any one point. And I think people think the way to do it is you find a property and then you have this massive list, you just splurge it out to everybody, and doesn't feel like the right or the best way of doing things to me. So yeah, to have that letting agency, probably to grow that. I don't want to be there day to day running it. Whether to do that on a JV basis or just have the right people there to run that, and that comes back to the whole systemization thing. But very much to be the front person of that, to bring my skills and experience to bear on that. So there are a number of things, and I think what's interesting is I've looked at those over the years, and I guess because we've had that low period of interest rates and everything's been sort of okay, you just tend to leave those things alone. And now, because of interest rates, I'll be brutally honest, the pressure's on to develop these other income streams. And I think what's really interesting is that we grow far more in those periods of pressure than ever we do when everything just goes along smoothly.
And you're really walking the walk there in terms of you were, I think, very ably explaining that it's good to have a trading business alongside your investment business. If you can kind of feed yourself from your trading business and you can allow the investment business to compound, that is the holy grail in many ways, and you would be heading in that direction. So how where can we send these good people to find you if they want to learn a little bit more, whether it's about these events that are coming in the future or just to follow you, because they've resonated with them, everything that you've shared with us today? Where's the best place for them to connect with you?
Probably social media. So from a Facebook point of view, I have a very large and very good serviced accommodation group called the Serviced Accommodation Network UK. And if anybody's interested in or actively in serviced accommodation, please do come and join us there. There's about 16,000 people in that group now, and it's very good. I've obviously got my own sort of personal profile on Facebook and a personal page. So please connect with me on either of those. And we have a more general property group, which is much smaller, and I would like to grow, called the Property Investment Community. But please, just connect with me on Facebook or LinkedIn. I'm not probably quite as prominent on LinkedIn, but it's something I'm trying to focus on a bit more. So I'm on there and very connectable via that channel as well. And that's probably the easiest way.
Perfect. So we'll definitely put those in, and when people click on those links and visit, they will be able to have a good look around, and there are links to click through from there to other resources as well. And obviously, please, explore, everything that Jason's got to offer. Jason, can I just end by saying thank you so much for your time today? I appreciate you've run over slightly, which I apologize for, but you've been really generous both with your time and your knowledge. I think there's been a huge level of value for all of us in this podcast. Just want to say very sincerely thank you very much, Jason.
No, thank you. I do genuinely enjoy sharing what I've been through. It's been painful at times, but I live to tell the tale, and if I can in any small way help others perhaps to have an easier journey, then I'm delighted to be able to do that.
Well, that's fantastic. Now, dear listeners, thank you very much for listening to Jason and myself today on the podcast. It's much appreciated. Please do like, follow, comment on the podcast, because it really helps get the podcast out to people. And it's, obviously we're trying to create as much value as we can. You're always welcome to connect with me on social media. My links will be below Jason's, and don't hesitate to join me at the next Property Investor Breakfast, where I'd happily discuss anything arising from this podcast. Thanks once again to Jason. Thanks to everybody for listening to the podcast. Thank you.